Hey everyone, Brayden here coming to you with a breaking Disney news update as Disney's Q4 earnings were just released. And oh boy, you guys, there is a lot of drama surrounding this event, and we will get into all of that as well as the numbers themselves. First, starting off with the drama that orbits this earnings season for Disney and these financial results that we got today. Around this time last year, I said that a storm was brewing at the Walt Disney Company, and a week later, Chapek was out. I am here to say once more, a storm is definitely brewing at the Walt Disney Company as Disney faces some significant issues. Chief among these is their stock price, which has been hovering around 10-year lows in terms of its nominal price per share. That's not even factoring in the inflation that we've seen during that time. In real value terms, Disney stock right now per share is lower than it was when I first started covering Disney a decade ago, which very much goes against the narrative that Bob Iger has, where it's all about how there's been tremendous growth over his tenure and they've acquired so many properties and things like this. The fact that their stock right now is hovering at 10-year lows really makes you wonder, if they acquired all these assets that were worth so much money and they spent so much money on them, why haven't those resulted in any sort of increase in value in Disney stock? It really is a puzzling picture there. So as far as why Disney stock is down, obviously there's many reasons for that, some of which are specific to Disney, which we're about to get into, but there's also some macroeconomic reasons and just sector, oriented stuff with, if you look at other streamers, other entertainment companies, they are observing similar losses in terms of their stock price over the course of this year. So it's not just specific to Disney. There are broader market conditions which are contributing to Disney's stock decline, but there are many specific reasons that are specific to Disney as to why things are going downhill at Disney in particular. Wall Street's outlook on Disney has not been great this year as the streaming hype is dead at this point. Nobody is super pumped up about, growth in streaming in the short term anymore. There's some people who still think over the long term streaming is going to be a profitable business, but now we've entered a consolidation phase in that industry where in streaming it's becoming less and less about growth and more about just turning a profit, just making money and staying alive. Consumers are cutting down on the services that they are subscribed to as the prices of each just keep going up and up and up. Disney Plus is completely stagnant right now. If you look at the mainstream headlines out of this earnings report today, which wasn't at all bad, by the way, this earnings report we're about to get into, it had some pretty bright spots, especially at the parks. Surprise, surprise. But you'll notice in these headlines about the earnings, it's all about how they say Disney added 5 million subscribers on the streaming end of things. That is a highly engineered figure, where if you take a look at the section of the report where Disney always posts their sub numbers, usually they compare it to the prior year quarter. They compare it to the same quarter the prior year, right? That's very normal when you're looking at these earnings reports. Well, I noticed, and this is very curious, all of a sudden looking at the subscriber numbers and the earnings results for the streaming, they changed the comparison from year over year to comparing to the results from 3 months ago, which is very strange. And even with that weird time frame Disney chose to compare to, domestically you can see Disney Plus subscribers are up a measly 1% over that period. So I was wondering what Disney was doing there, so I dug through the Q4 fiscal 2022 earnings to find out why Disney didn't want to use those numbers to compare to. And sure enough, this time last year, Disney Plus's domestic subs were 46.4 million as compared to 46.5 a year later. So streaming is very stagnant in growth right now, and by simply tweaking what they're comparing to, they were able to change the narrative out of this earnings report from Disney's streaming business is stagnant, they are not growing, into something about how they did see some growth and how they're getting closer to achieving profitability. And this is a good example of where Iger is very good at the framing and getting the media headlines to look good. Chapek was not too good at that, where this quarter last year, you'll recall, was the one where, everyone was was saying, oh, Chapek did a terrible job. Chapek needs to get out of there. These earnings were terrible. And I think that if Chapek last year had done a lot of the trickery, I shouldn't say trickery for legal reasons, but some of the curious stuff they did this year on the earnings report, perhaps it would have looked better on Chapek if he had actually done some of that stuff. But it seemed like Chapek's knowledge on the financials and control over the financials and how things looked on the earnings wasn't totally up to him. It had a lot to do with the CFO at the time, which seemed to be sabotaging Chapek's position. Not to come out as a, Chapek defender or something. I'm not. The point is that this is a strong suit for Iger, is how he frames it all. Also, big news at this hour, Disney is getting themselves deeper into debt. They are buying Comcast's share of Hulu. Comcast owns a stake in Hulu, and Disney's buying it from them for the agreed price of $8.61 billion. That is what they are expected to pay. Disney's sending $8 billion to their competitor, who is building a brand new theme park down the road from their own resort in Florida, which is absolutely wild. The results from the parks, as I mentioned earlier, were very good. They were definitely the bright spot, and we will get into all of that. But first, as I mentioned, the drama. So as you recall, earlier this year, activist investor Nelson Peltz waged a proxy war with Disney. He released that slide deck which highlighted how Disney was underperforming, what he'd do with the company, many things which Iger has since implemented, such as cost cuts, which today Iger added $2 billion to, bringing their total cost-cutting target up to $7.5 million. Iger's also been promising the return of the shareholder dividend, which was one of the main components of Peltz's campaign promises last year. After Iger said that he'd implement some of these reforms and bring back the dividend, right the ship, and all of these sorts of things, Peltz backed off and exited the proxy fight in February of this year. And if you recall, that proxy fight was all about Peltz getting himself or some of his people on to the Disney board. And Peltz is not alone in believing that the Disney board that we currently have is inexperienced and incompetent. Ike Perlmutter, who owns a massive chunk of Disney stock thanks to the Marvel acquisition back in 2009, he was the head of Marvel Entertainment at the time, he supported Peltz behind the scenes in Peltz's proxy fight earlier this year. And I speculated at the time that it was likely that Ike was really the one behind that proxy battle. As we know, historically, Ike Perlmutter has a big problem with Bob Iger and feels that Bob Iger is really not about being smart with using the money that they have, where he puts his investments, where he puts his focus. He feels like Iger is this Hollywood guy who's all about the show business and all of this, and that's really not what makes money at Disney. It's the merchandise, it's the parks especially, and Iger does not have much knowledge or care insofar as those things are concerned. He delegates those to other people, and he remains all about the movies and these things which really have not done that particularly well as of late. So what was interesting was when Peltz exited the proxy fight earlier this year, Ike Perlmutter was immediately laid off from Disney. Iger sent him packing. So it's very obvious at this point, it's very apparent that Ike was the guy behind the push to dethrone Iger and get new people on the board. And that attempt for this past fiscal year failed. Now we are in fiscal year 2024, currently at the Walt Disney Company, and it looks like, according to the newspapers, the Wall Street Journal in particular, that Peltz and Perlmutter are looking to reinitiate that proxy war very soon. Why are they doing it now? Well, the shareholders at Disney have between December 5th and January 4th to nominate new directors for Disney's board, which will then be voted on at Disney's annual meeting. So that'll be the window that these guys have where they can make a push to shake up the board at Disney, which in turn decides the C-suite at Disney, which in turn decides Disney's destiny. So this is a big deal if it happens. And what's different this time is it isn't just Peltz out front and then Ike, doing stuff behind the scenes. Now Ike Perlmutter is out of Disney, so he can say and do whatever he wants. This time around, Ike is combining his massive amount of shares with Peltz's in order to give them a total of $2.5 billion in voting shares at the company. That is a lot of shares. That is a lot of interest and pull that they now exert over the board and over the company. By comparison, according to the Journal, Iger only has $15 million in shares, and the rest of the board combined only holds around 15 million. So these two, Ike Perlmutter and Nelson Peltz, they hold a lot of influence if they want to push to shake things up, and that appears to be exactly what they are gearing up to do. And while they haven't launched a campaign yet, it seems like that is coming very soon, as over the weekend, Ike Perlmutter, who historically prides himself on never talking to the press, never giving them anything, he gave a statement to the Wall Street Journal saying, quote, "While I was a Disney employee, I was not comfortable publicly stating my views on the company and its performance. As someone with a large economic interest in Disney's success, I can no longer watch the business underachieve its great potential." All this in mind, while Peltz and Perlmutter do have a serious chunk in voting stock, much more than the board or Iger or anyone like that, these individual stakeholders pale in comparison to BlackRock and Vanguard, who currently own almost $23 billion in stock in the Walt Disney Company. I suspect it's those institutional stakeholders at Disney who currently dictate what happens, who comprises the C-suite, what the goals are, how the content is, the messaging in the content, all of that ultimately lies at the feet of BlackRock and Vanguard. They really dictate the course that Disney's on, since they have so much control over the company in terms of their voting interest in it. But here's the thing, those controlling interests could be convinced that someone else in charge would be better than Iger, and there is blood in the water. Peltz and Ike, they could definitely go for it here and try to push to reconstitute the Disney board, push out the old guard that's been keeping things same old in Burbank since Eisner left. It's been this way for so long, where we've had the Iger regime and these board members which keep coming and going, which really don't seem to be all that knowledgeable on Disney or all that qualified to even be on the board. And you can make the argument that someone like Peltz, who sort of like takes over these companies and tries to correct them, you know, these activist investors, do they really know how to best run Disney, this giant entertainment company that's very confusing and has so many moving parts? You know, the jury's still out on that. But we can definitely say with confidence that Ike Perlmutter does have some knowledge of the company. He's been with the company for a long time. And even if Nelson Peltz and Ike Perlmutter, they succeed in their proxy war and they redo the board and they redo the C-suite and, you know, who's in charge of the company and the course, they try to change it. You know, I'm not entirely convinced that they are going to set Disney on the right path. We still have this issue at Disney where all the options in terms of who's running it, how it all works, it's all these MBA types, you know, who are trying to increase the stock, which is ironic because the stock hasn't actually done that well. It's just that I long for the days when this was a company run by folks who weren't just interested in showing returns to shareholders over the short and medium term, but it was also about living up to Walt's vision, Walt's principles, and doing something that they were proud of on a personal level. They were interested in things greater than just numbers on a chart. The numbers on the chart existed to fund bringing these ideas to life, making these projects that they were proud of. And Disney hasn't been that way now for quite a long time. And I'm not sure that Nelson Peltz and Perlmutter, who are all about the bottom line and bringing in returns, they're going to be a whole lot better than what we've seen under Iger or Eisner. But I think most of us here are ready for some sort of change on Disney's current path. They're really taking the fast track to nowhere. So I'm definitely in support of seeing a shakeup here and seeing what new people in charge really could do with the company. What do we have to lose? And Iger here, he seems like he's in a pretty weak position lately. It seems like he really doesn't know what to do. He has some sort of ideas like bringing in strategic partners for ESPN and consolidating all Disney streaming into a one-app experience, which I think could be better set up than what we have, where they have all these individual applications and it's all quite confusing. Here's the thing though, is that I noticed on CNBC, he did an interview today, and Iger said something which is a little bit uncharacteristic of Iger. He said something like he doesn't focus on the short-term gains in the stock. He's basically casting aside the fact that the stock is underperforming. He says that he's not worried about the stock in the short term. It's all about long-term success in the stock, long-term gains, which sounds nice, you know, just as a sentiment. But when it comes to Iger, Iger's the guy who loves to pump the stock. This is the guy who many times has made these acquisition moves, which seemed mostly about pumping the stock in the short term, which he then in turn capitalized on and sold a ton of his stock. He has sold much of his share in the company. The Fox acquisition is the chief example where it's hard for anyone to justify how that was a great move for Disney. It put them in all this debt that they've been dealing with ever since, where it's really paralyzed them and kept them from investing in the things they want to invest in, like streaming and the parks. They've had to limit their investments on those. But that Fox acquisition, who is it great for? Well, it was great for the shareholder in the short term. Those shareholders being, we see the institutions that Iger is beholden to, like the BlackRock and Vanguards, but also Iger himself. You know, he announces, hey, we're going to do this giant Fox acquisition, and they have all these tens of billions in assets that are now going to be under the Disney banner. Well, naturally, the stock jumped on that, and he cashed in on that pump. Now, when the results are looking iffy, and the streaming business seems quite stagnant, and the linear TV networks are losing advertisers, and he's looking to offload networks, including perhaps ESPN, and Walt Disney World is seeing some declines. Now all of a sudden he's saying, oh, I don't care about, you know, the short and medium term stuff. I don't care about the stock. I'm all about the long term. Tell me what Iger's done lately for the long-term growth at the parks. He's done nothing lately. We have almost nothing on the roadmap beyond a retheme of Splash Mountain and some DVCs that are going to continue being built. The real question I have is, where is the investment? Well, Iger claims it's coming to the parks quite soon, and it's about time that we delve into that. So taking a look at the parks results, this is where these earnings were stellar. As I told you guys, this is not a miss. These are not lukewarm results. These numbers out of the parks this quarter were insane. Check this out. The experiences and products segment, which is mostly comprised of Disney parks, saw revenues up 13% year over year. And here's the crazy statistic. Operating income is up 31% compared to the same quarter last year. This is significant growth, and Disney isn't cagey about telling us where it came from. It came from Disney's investment in the cruise line, where they are now selling more rooms to more passengers on more ships at higher prices. And also Disney sold DVCs for the villas at Disneyland Hotel. This is why we are going to continue to see DVC properties pop up year after year at the parks, because they are a sure thing and they pump the earnings results every single time. Despite these pretty stellar results, which are largely thanks to the cruise line, the DVCs, as well as better performance at Disney's international parks, the resort, which usually shows the best growth and is always printing tons and tons of money, Walt Disney World, the results were not as good there. Disney attributes the decrease in performance at Walt Disney World to realized losses with the Galactic Star Cruiser, but more concerning, lower guest spending and lower room rates at their hotels. Disney has reached the ceiling in nickel and diming us at Walt Disney World, where while they still are doing some price hikes here and there on things like food and sodas and stuff like that, it seems quite evident that Disney knows that when it comes to Walt Disney World, they've juiced us for all it's worth. Perhaps they've overjuiced us, where now people are choosing to go elsewhere. If you've been wondering where I've been the past few weeks and why I made that giant video before I left, the past few weeks I've been on a road trip, which has taken me all over America, and I visited several tourist areas on the eastern seaboard that Disney does not have a stake in currently, and business was booming in those areas. Namely, when I was in Gatlinburg and Pigeon Forge, Tennessee, where you have Dollywood and the Great Smoky Mountains National Park, families were saying, you know, we opt for this instead of Disney because it's a better value. And maybe a few years down the road, we'll do a big Disney trip and we'll be able to afford to do that. And I think that's the linchpin where in the Chapek era, you know, the price hikes that we saw, they in turn resulted in a fundamental shift with a lot of families who did once a year or once every couple year family vacations to Disney, where now since Disney is so expensive and Disney hiked the prices so severely so quickly, even folks who love Walt Disney World said, you know what, we're gonna have to make Disney a once every 4 or 5 year thing for our family, and in the interim, we'll look for alternative places to go that are more affordable, like, and this sounds crazy, Europe. You can go all over Europe with your family right now for less or the same as going to Disney. You know, why walk around the world showcasing imitations of places from around the world when you can just go explore the world itself with your family for less money than going to Disney? Or the other thing that they're doing is families are opting to do a more convenient travel destination, something closer like a national park or regional amusement parks. And these are things that have seen massive growth in attendance as of late. And I think all of this is because Disney very proudly threw out the age-old policy that they always abided to, which was as simple as charge a lot, but don't charge so much as you prevent your guests from coming year after year, which is to say, don't milk the cow all at once, never to return, because that will result in medium and long-term losses. And that's exactly what Disney did at Walt Disney World in 2020, 2021, and 2022, in my opinion. And quite funny was Iger during the call talking about how well Walt Disney World is done. If you go back to 2019 and compare it to back in 2019, that period where he's saying that there was all this growth in guest spending, that happened under Chapek, who was very hands-on with the parks in his time as parks chairman and later CEO. Chapek, as I just detailed, probably messed up the entire business permanently by trying to milk guests all at once instead of a bit at a time. But the short-term gains that change in policy accrued were squarely thanks to his management decisions at the parks, which Iger, as you recall at the time, was criticizing. Remember, he was going to the newspapers and saying, I don't like Chapek. I regret ever putting Chapek in charge. Now that Iger is back in charge, he's bragging about growth that happened in the period where he wasn't in charge. And in Iger's new interim, he has not undone the changes that Chapek made with things like Genie Plus to increase guest revenues. Iger has not meaningfully lowered prices at the parks or got rid of the things that give us a headache. They're slowly rolling back the park reservations over time, but I think a lot of that is due to just decreasing demand. That's why Disney said that they had to reduce the room rates. What do you think that was about? There's less demand, so they had to lower the prices on the rooms to get people to actually use the rooms at Walt Disney World. Lastly, we have a glimmer of hope for the parks that I want to touch on here, and that is the $60 billion that Iger has stated they want to invest in the parks over the next 10 years. Now, keep in mind, a lot of that is going to go to the cruise line, as well as things like more DVC properties. These are all things that are sure things, but still, $60 billion is a lot of money. Now, it's pretty much what Disney spent the past 10 years at the parks, and if you factor in inflation, it's actually, I think, less than Disney spent in CapEx over the past 10 years at the parks. But still, $60 billion, we should be seeing some part of that at Walt Disney World, right? New lands, new rides, all sorts of cool new stuff. And during the interviews today and the earnings call itself, Iger can't stop going on and on about how he wants to invest in the parks, how he now wants to invest in success, which is what we've been saying that Disney should do for ages. Disney has this corporate philosophy. This has been the case throughout Iger's term since he first became CEO. They constantly invest money in their underperforming assets, their failing assets, the segments that aren't doing so good, instead of doubling down on the winners and letting the losing assets and divisions fall away and doubling down on what is working. Double down on the parks. Earnings after earnings, what do we see? Streaming is a bad business. Streaming is accruing all this debt. Meanwhile, parks is printing money. So invest in your parks. It doesn't seem like that complicated, right? Well, Iger says that's exactly what they're going to do. He says that they are investing in the parks for the long term, that he's bullish on the parks. They keep saying that they're going to turbocharge the growth at the parks and all that sort of, all these like sayings. Despite all of that, we still have no news in terms of new lands, new rides, or new investments at the domestic parks. And remember, any project along those lines will take probably around 4 years or more to build, from the time they announce it to the time that is actually completed. So even if we got something concrete for the Animal Kingdom and the Magic Kingdom, those land expansions, if we heard about those today and they said we're going to start work on it, from the time that they announce it, we'd likely be waiting around 4 to 5 years to actually get and be able to enjoy those investments at the parks. So the longer Iger keeps talking and the longer we continue to hear nothing, it means it's just that much longer till we get to experience anything new out of Imagineering beyond the retheme of Splash Mountain. And we have some sources at Imagineering, so if anything crazy was happening behind the scenes, we'd hear something about it. The Imagineers aren't going to give us the whole, 4 411, but they'll definitely say, hey, there's some big stuff going on. So what I have to say to Iger is put your money where your mouth is. Announce new projects concretely for the parks. No more of this "we have ideas" nonsense. It's so clear the parks don't have money for new projects. That's why everything remains in its idea stage. We just had that D23 event where they weren't able to announce anything. It was all, we're thinking about doing this, we're considering doing that. And meanwhile, Walt Disney World president Jeff Volley keeps cutting the budgets and taking stuff out of the parks that we've enjoyed for the longest time. Think about it. This time a decade ago, for the holidays at Walt Disney World, we had the Osborne lights and we had the Dream lights on Cinderella Castle. Now we have neither. The lights on the castle, which need to be fireproofed annually, cost around $3 million to do. That's the quote that I heard back in 2019 when they were put on the chopping block. But Jeff Volley seems to think that projections are sufficient and that not putting the lights up is a great way to make extra money by cutting stuff out of the budget, reducing the budgets at the parks. And very interesting, a friend sent me this from Instagram. Usually it's very positive and pixie dust on Disney Instagram. All Disney's holiday posts, they are being flooded with comments from fans saying, where are the castle lights? These projections are lame. It seems that Disney was able to trick people into thinking the reason they didn't do the lights in prior years had something to do with the 2020 lockdowns. That is not why. Back in 2019, we were hearing, and I reported that that was going to be the last year of the Dream lights and that Walt Disney World's leadership did not want to do those anymore. They are an expense that they thought that they could cut out, and once they did cut it out, they didn't see some meaningful change in guest feedback. So if you get one of those Disney surveys, anytime they let you write in one of those fields, say, bring back the Dream lights, because otherwise Disney's going to say, we saw no difference in the guest feedback. So I guess it was good that we cut that out. So all this is to say, while we're getting nickel and dime to death at the parks, they can't even deliver the same experience that they were able to just a few years ago. Yet at the same time, to the investors, Iger says everything's great. They're investing $60 billion at the park. No, you're not. Even the CFO admitted during the call that their stated investment in the parks over the next 10 years, which is subject to change at any time, it won't materialize in any tangible returns till the latter half of that 10-year window that they are talking about. Not to mention, now is the worst time to be borrowing money. The rates are insane, and when the rates were basically zero and borrowing money was practically free back in 2020, Comcast funded an entire new park at those ultra low rates, which they locked in, while Disney sat on their hands and cut back on capital investment, as simple as just finishing building Tron and Guardians, which ended up taking ages to complete as a result. Now when interest rates are at decade highs, Disney comes out and says, hey, we want to invest $60 billion. It's just bad timing, no pragmatism, and fundamentally it's all talk. Where's the money, Iger? Where's the money, Josh D'Amaro? Give us a project. Actually announce something for the parks. I want to see a post on the Disney Parks blog that says, we are doing X. No more ideas, no more we are considering, no more we're thinking of this. Keep being that way. And lots of fans, you know what they're doing in the meantime? They're thinking about the idea of, they're considering the idea of, hey, how about we go somewhere else? It's really that simple. Let me know what you guys think of this earnings season for Disney in the comments below. What did you think of all of this? Be sure to subscribe with those notifications on to stay up to date on the latest news. I'll stay on top of anything further regarding a possible renewed proxy war heading into this board election season. And remember, this video was just news about the company as a whole. We still have a video on the way that'll be about the latest Walt Disney World news, so stay tuned for that as well. If you enjoyed this video and would like to support the creation of these videos, be sure to check out mickeyviews.com/support to find out how you can. Thank you all so much for watching. Also, stay tuned for the Mickey Views store, which will be launching very soon at mickeyviews.store. From the Mickey Views Magic Studio, this is Brayden. I'll talk to you soon. Have a magical day.